Every once in a while, a stock just goes parabolic, and everybody's trying to figure out what just happened. Well, that's the story with FGL Holdings. So today, we're going to tear into the technical report that breaks down one of the wildest single-day moves we've seen in a long time. All right, let's get into it.
So this is the number that just blew up everyone's screens. On October 28th, FGL didn't just go up, it absolutely launched, closing the day nearly 28% higher. I mean, a move like that, it's just impossible to ignore. And that right there leads us to the million-dollar question. Was that insane surge the start of a massive new rally? Or was it just a classic bull trap, designed to suck people in right before the floor drops out? Well, the technical report gives us some really fascinating clues. Okay, first things first, let's really get under the hood of what happened on that one crazy day. We've got to look past that headline number to really appreciate the raw power behind this move. Now, here's what's really wild on this slide. Forget the price for a second and look at the volume. Over 204 million shares changed hands. I mean, that's a whopping 37 times the volume from the day before. This wasn't just a quiet little climb, it was an absolute stampede. So with all that firepower, you can bet the bulls have a pretty compelling story to tell. Let's dig into the technical indicators from the report that are flashing bright green. At the heart of the bullish arguments is one word: momentum. All the data is suggesting that a really powerful short-term uptrend has kicked in, and it might just be getting started. Now, to really get this, we have to talk about an indicator called the ADX. The simplest way to think about it is like a speedometer for a trend. It doesn't tell you if the car is going forwards or backwards, just how fast it's going. And anything over 25, that's considered a strong trend. And boom, here's the proof in the pudding. Look at that ADX value, 38.41. That's not just strong, that's really strong trend territory. And you stack that with a positive MACD and an on-balance volume that suggests accumulation, well, that's a sign that big money was likely buying in, not getting out. And listen, it's not just the fancy indicators telling this story. The price itself is screaming it. The report points out that the price just blasted right through its key short-term moving averages, like the 5-day. That's another classic signal that the momentum, at least for now, has shifted firmly to the bulls. All right. Buts. And you knew there was a but coming, right? This is a huge one. The report is also just loaded with warning signs. It feels like for every go signal, there's a big flashing red light right beside it. A really good way to think about the bearish argument is that this engine, while it's super powerful, might be running way into the red. The technical term for this is overbought, and the signs are, well, they're pretty hard to miss. So the main warning light here is something called the stock RSI. It's basically designed to tell you when a stock has moved too far, too fast, which makes it super vulnerable to a snapback. And its maximum reading, the absolute top, is 100. And wow, look at that. The Stochn RSI is pegged at 100. It literally cannot go any higher. That is a massive signal that this rally is stretched to its absolute limit and could be due for a cool down. The money flow index, sitting way up at 94, is telling us the exact same story. Okay, so this slide right here, this is the whole tug of war in a nutshell. You look at the short term, and yeah, the stock is flying high above averages like the 5-day. But then you zoom out, and it's still way below its long-term 200-day average. What we're seeing is a short-term explosion inside of a much bigger and still unbroken downtrend. So you've got these two massive forces just battling it out. Where does that leave the stock? Well, the report takes all this conflicting data and boils it down into 3 potential scenarios for what could happen next. Okay, scenario 1, the bullish dream. The momentum just keeps on trucking, volume stays huge, and the price smashes through its recent high. Then you've got the flip side, the bearish case. That engine finally overheats, those overbought signals take over, and we see a pretty sharp fall. And finally, there's the neutral path. The tug of war ends in a stalemate, and the stock just chops sideways while the bulls and bears try to figure out who's really in control. So, after we've weighed all the evidence, we've heard from the bulls, we've heard from the bears, we've looked at the possible paths, what's the report's final take on all this? And that quote just nails it, doesn't it? It perfectly captures that tension we've been talking about. It's a momentum play. Absolutely, but it's a momentum play that's happening inside a much riskier long-term bearish picture.
All right, let's just boil this all down one more time. You have this incredible short-term momentum smashing head-on into these extreme overbought warnings, and this whole battle is taking place inside a bigger long-term downtrend. So the report's conclusion is crystal clear. This is a classic high-risk, high-reward situation. So the data from the report really paints a picture of a stock on a knife's edge. It's a true tug of war between this incredible short-term force and some pretty significant long-term headwinds. So the question it leaves us with is really a personal one. In a situation this polarized, where do you see the balance between that opportunity and that risk?